Hello. So the company being analyzed today is Interglobe Aviation or Indigo Airlines. This company is India's biggest domestic airline. All right. As you can see, by passenger traffic numbers, domestic passenger traffic numbers, the company has a 65% market share. So it's extremely dominant in India. And also, it may be the most efficient and profitable airline in India. Like, there is a what do you call a parameter used, okay, parameter used known as load factor. See, load factor. The load factor, you can call it as utilization of capacity in a way. How much of the seats that an airline has, how much are they being filled in a way? So capacity utilization of an airline. And it was 84.1% for Indigo. 84.1% of its capacity was being efficiently utilized. Air India, only 78%. CASA Air, 90.2%. India One Air, okay, 60.4%. So, in terms of profitability, market share, and efficiency, it may be India's top airline. So the purpose of today's segment is analyzing the company's financials, okay, historical financials. How well has it done historically speaking? What are the company's future outlooks? Its cash flows. How does it produce such good cash flows? We're going to analyze its cash flows. We're going to analyze its debt. And of course, future outlook, as I said earlier. Let's start. So, Interglobe Aviation, market cap 2,14,968 crore rupees. Massive. Current price of one share 5,561 rupees. Book value, which is assets minus liabilities. So book value per share is 241 rupees. Stock PE or price to earnings 32. ROCE, return on capital employed 17.3%, and a return of equity of 104%. Not 10.4, I hope. That's 104% return on equity. So extremely high return on equity. That's because of the business model of the company, why the return on equity is so high. We will discuss that maybe. And return on capital employed, a really nice 17.3%. So, time to look at the company's profit and loss all the way from 2014 to 2025, or yes, 2025. You got sales, you got operating profit, you got operating profit margin, which you may notice is very, very volatile. Okay, so operating profit margins are a bit volatile. The airline industry is such that profit before tax and after that the net profit, the final thing. So let's look at sales, and all these numbers are in crores. So in 2014 we have sales of 11,117 crores. In 2018, all the way 2018, 23,021 crores of sales. So okay, nice. Then 2020, we have 35,000 crores of sales. Pretty good growth. 2021, COVID. Then the post-COVID boom came, massive increase in revenues. So now 2025, we have 80,803 crores of sales. Then on my right, we have 18,050 crores of operating profit, giving us an operating profit margin of 22%. The numbers below 22%, these are other income. So this thing is other income. Okay. This is interest. And this 8,000 crores, massive amount, that is the depreciation. Now, depreciation is a non-cash expense. Okay. It's not really something that goes out of the company's, let's say, cash reserves, the company's bank balance. And you can notice depreciation. See, depreciation 8,000 crores. It's more than the profit before tax. You can see 7,588 crores. And finally, we got a 4% tax rate, which is pretty low. 4% is very low. Finally, coming to a net profit after tax of 7,253 crores to my right. Okay. Now let's see these numbers in percentages to get a better idea. So in the last 10 years, the company has seen compounded sales growth of 19%, 5 years 18%, last 3 years 46% compounded annualized sales growth, and TTM refers to trailing 12 months, so 14% growth there. So double digit, mostly shown nice growth. Now, last 10 years, it has shown a profit growth of 17%, 5 years 53% compounded profit growth, 3 years 43%. This 5 and 3 years could be due to the post COVID boom, and TTM trailing 12 months profit actually declined by 14%. I believe this was due to larger maintenance cost, not even fuel cost, which are significant. I forgot to mention fuel costs are significant for airline companies and are usually, or they are the biggest expense for airline companies. But what can you say? Maintenance, all right, getting new fleets, fleet maintenance, all that is clearly the second biggest. And for Indigo, that expense rose a lot this year, which led to their profit decline. Return on equity, I don't know, they don't have it 10 years ago, even 5 years ago on screener. So, okay, that's bad. Then cash flows, very, very important. Cash flows. The company has displayed some incredibly nice cash flows, to be honest. Okay, cash flows, only pay attention to the cash from operating activity. So in 2014, we have 1,595 crores of cash flows. Okay, 2016, 3,000 crores of cash flows. Basically doubled. 2017, 3,700 crores. We move forward. Okay, 2021, this is minus 1,600, COVID. Then even 2022, okay, so 2022, 2025, massive growth, 24,000 crores in operating cash flows. If you're wondering why are this so big, like this number, 24,000 crores, it's even bigger than the operating profit of 18,000 crores this year. So let's discuss that. Now, before we say that, we discuss that, look at this. After COVID, we saw a massive boom, okay, 2021 COVID. Even before COVID, we saw good growth. Okay, the company actually saw good growth, not we. See, 22,384 crores 2015, all the way to 6,943 crores. Yes, there were fluctuations, you can see, but still, it was on an upward, very, very nice high growth pace. And even after COVID, you saw operating cash flows, all these numbers rise massively, operating cash flows. This is because, see, Indigo, okay? It receives money from customers in advance. Like we book tickets on advance. We may book, let's say, food, meals on that, meals on the flight on advance. So it receives money upfront, and what it does that it has suppliers. Indigo gets its food. Indigo gets maintenance of its flights from different other companies, third party companies. And what it does is that it negotiates with them and it delays these payments. So Indigo gets cash from customers first on tickets and all that, and food and all that, and suppliers for this food, suppliers for fuel, the fuel suppliers, and maintenance of flight, those companies, all of these companies are paid later. So it first receives money and then gives it to suppliers after, of course, receiving it. So that's why its operating cash flows. It's one of the reasons why its cash flows are so massive. Okay, one of the reasons. Other is because it has such a strong negotiating power with suppliers. It is the largest airline, of course, and it delays the payments because of its negotiation power and all that. So that was the company's financials. We saw great operating cash flow growth. Okay. We saw that its profits have grown. We saw that margins are a bit volatile, ov- morely up, overall up, and revenue is very solid. So let's see what the company actually does. So here we have the annual report. Indigo Airlines. It's ranked among the world's leading airlines, seventh largest by daily departures, one of the fastest growing, one of the highest aircraft utilizations in the world. Very important. Okay. One of the largest order books. What are order books? Order books for new flights. Order books for new flights. Now, moving onwards, we have. Yes. Operational and financial highlights. Now here we have fleet size first of all. Okay, let's see fleet size. Total number of planes for the past 5 years. We see a good growth from 285 in fiscal 2021 to now 434 fleets in fiscal year 2025. Now, you see this 434, by 2030, they want 600 fleets. By 2035, they want 920 total planes in their fleet. So they are aiming for a lot of growth. Okay, they have said this. Now, available seat kilometer. Now, what is this available seat kilometer? You can think of this as the total passenger flying capacity. They can fly all their passengers how many kilometers. So the capacity, total capacity, you can think of it of the company, and you can see it's in millions, I think, kilometers, and it has seen rapid growth. Currently at around 157,474 million kilometers. The more this grows, better for the company, of course. Employees have increased. Employees, of course, important and a significant cost for the company, expense, necessary expense, of course, but a big expense for the company. Then we have the load factor. This is again like the capacity utilization we saw. It has increased. The more this increases, the better it is for the company. 86% and has increased over the last few years and is the highest, I think, among Indian airlines and among the world. Then revenue from operations. Oh, sorry. Revenue from operations in millions of rupees, you can see, have experienced a nice post-COVID boom. You can see the EBITDA margins. Now, this includes other income. Okay. Now, revenue from operations, even this includes other income. EBITDA here also includes other income. Other income, as in income on interest on deposits. This is a non-operating income, okay? Not generated from the company's operating activities. So, EBITDA and EBITDA margin, this was due to the COVID times, okay? This extremely low margin. And these are some really, really high 26% margins. Sustainable or not? That is an interesting question. Total cash of the company has increased in millions of rupees. They should be around, if I'm correct, that is around 41,000 crores in cash. Total cash of the company. Okay. Wait, 41,000 crores? Um, yes, 48,000 crores in cash, which is impressive. 48,000 crores. And profit after tax, you can see last 3 years negative. Sorry, fiscal year 2021 to 2023 negative because of again COVID. Then past 2 years, nice. Also, also the Russia-Ukraine war must have affected the company badly because fuel prices rose so significantly. And even aircraft jet fuel prices must have risen significantly, and that must have affected the company's profitability again because it relies so heavily on this. Now we've looked at a lot of numbers. Finally, let's look at the balance sheet of the company. Yes, here we have the consolidated balance sheet. Okay, now let's take a look at a few things highlighted. Let me make this a bit smaller. Little more. Yes, perfect. Investments. The company seems to have a lot of investments and other financial assets. Okay, the thing we're going to look at here are the cash and cash equivalents. The company has cash and cash equivalents of around, again, all of these numbers are in millions of rupees. So this should be 1,000 crores in cash and cash equivalents, while bank balance, other than cash and cash equivalents, are a massive 17,000 crores. Okay, a lot of bank balances and total current assets. If you can see this, current assets which can be converted into cash within 1 year. Total current assets are a massive 50,000 crores, 507,031 million rupees. 50,000 crores. Now, 50,000 crores are the current assets. What are the current liabilities? Okay, what are the current liabilities? Um, where is it? Where is it? Where is it? Yes, current liabilities total around 34,000 crores. So current assets divided by current liabilities gives us the current ratio. If it's less than one, it's not necessarily concerning. It depends on the industry. But if it's more than one, higher the one, it could be seen as good. 34,000 crores of current liabilities compared to 50,000 crores of current assets. That is really nice. Now, one important thing that I was supposed to show, but I haven't shown, is this. Yes, I should have shown this. Now, not efficiency at the helm. No, we're talking about this. You see all these flights, these are all the aircrafts of Indigo. All right. All these aircraft are of Indigo and all of them are leased. Okay. It does not own any of the flights, it leases them. Now, this is incredibly important to know why they have leased all of this. It means that all of its assets, the main important assets, which are the aircrafts, they are on lease. They don't own it, but depreciation for leased assets still happens. So that massive depreciation expense seen earlier was because of, okay, they don't own the assets, but they have leased it. So depreciation expense is massive. Now, the significance of them only having these leased, damp lease is a type of lease, these leased aircrafts is that the maintenance capital expenditure for the company is already included in the profit and loss. Okay, maintenance capital expenditure is the expenditure the company makes to maintain its assets right now. The company, Indigo's biggest assets are going to be its planes. So, if it leases them, all right, its maintenance capex is just going to be maintaining those planes, maintaining the, what do you say, maintenance and all. Okay, repair and maintenance are going to be the main thing. They don't own the assets. And buying new planes, like buying new planes, all of those expenses are already included in the profit and loss. So the company's maintenance capital expenditure is already included in its profit and loss statement, or most of it, almost all of it's included in the profit and loss statement. It's already accounted for in like net profits. That's all I wanted to mention. Yes. Finally, we move on. The profit and loss statement. Profit and loss statement. Again, I don't know if it's clear. I think it should be a bit bigger. Yes. Now you see income, revenue from operations, other income. We will see other income, what it is. Now, aircraft fuel expenses. Again, rupees, all of these are in millions of rupees. Aircraft fuel expenses, you can see, are single-handedly the biggest expense. See, so they rely heavily on aircraft fuel prices. If fuel prices rise significantly, it will really damage the operating profits of the company. Then, supplementary rentals. Let me make this bigger. Yes, supplementary rentals and aircraft repair and maintenance. So, aircraft repair and maintenance. See, again, it's already included. Okay, maintenance of aircrafts. It's a significant expense also. Now, supplementary rentals, you may wonder what this is. Rentals as in rent. So again, they are leasing these aircrafts from the lessor, the one who owns the aircrafts. So they pay like a monthly fee, a monthly rent to the lessor or the company they are leasing the aircraft for a maintenance reserve. So they give the money, they give this monthly payment to the lessor, and the lessor can use this money for the major maintenance expenses in the future. All right. So this money is basically given from Indigo to the companies it leases the aircrafts for maintenance and all that. Future major maintenance of aircrafts and all that. So it's a major expense compared to last year. You see, last year it rose from 9,900 crores to 11,000 something crores. I think so. It is a big reason. Why will the profits kind of did not be this year? Then employee benefits expense, you can see right here. I think that's 7,000 crores. Major thing, but necessary employees. And of course, as I said earlier, depreciation and amortization expense, non-cash expense. It's more than profit for the year. Again, non-cash, and it has a lot of these advanced aircraft. They're also depreciating. What is this? I don't know if you can hear that, a lot of noise in the background. But these leased assets, they will also be kind of depreciated. That's why the depreciation expense shows up. Finally, now it's time for this. Okay. The free cash flow, a DCF, discounted cash flow model. Not really. Only the free cash flow of the company, the free cash flow yield of the company, how well has it done? Now, the free cash flow yield of the company was 8.24% around this year, massive yield. You can see the growth of free cash flow between 2015 and 2025, 24% annualized growth rate. Last 5 years has been 34%, the post-COVID, and last year was 10%. So massive free cash flow yield and really nice double-digit growth. Now, last year was a bit slow, but you can say that before COVID, sorry, after COVID, there was such massive growth in free cash flow. It's expected a bit of a slowdown. If you're wondering what free cash flow is, free cash flow is considered as one of the most important metrics in valuing companies. I mean, I hope it is. I mean, it is considered. It's very important metric. It's basically the real cash the company has left after funding its operations. Yes, and after incurring maintenance capital expenditure. So, the money the company has left, the cash the company has left after funding the company's day to day operations and then funding expenditure to maintain the company's assets, maintenance of the assets. Okay. You can see free cash flow. You've got cash flow from operations, you've got maintenance CapEx, you've got interest payments. Interest payments are included because I think under the current accounting rules, interest payments, interest on loans, they're included in cash from investing activities, not no cash from financing activities. Cash from financing activities and not um, cash from operations. Now, earlier I said that all of its maintenance capex of this company are included in the P&L. So why am I taking it here? Good question. Now, maybe having no maintenance capex can be a bit can be a bit optimistic. So just as a conservative measure, I'm showing even even if we assume all of the capex it is having, all of this capex it is having, it's in the form of it's actually maintenance. It's not growth capex because see, Indigo is building new assets, it's building new repair facilities, and that will of course be not a maintenance capex. You can see it as a growth capex. But even assuming if they're maintenance, all of this is maintenance, which it can be. I can be wrong. All of this can be maintenance capex. Even then, really nice free cash flow yield of 8.24% and really nice free cash flow growth. 2014, we have free cash flows of 1,200 crores. Okay. Then till 2020, we have seen fluctuating but rising cash flows overall. 3,000 crores 2018, 3,900 crores in 2020, dip, COVID, and after that, massive increase. 2023, 8,900 crores. 2025, 17,702 crores in free cash flow, pure free cash flow. Great. Now, finally, the future outlook of the company. Okay. The future outlook of the company. I already mentioned it, but why not? The company has over 430 aircrafts right now, right? And they have a vision of becoming an airline with over 600 aircrafts by the end of the decade. So by end of the decade, while expanding its international footprint across Europe, UK, Asia, Africa, and the Middle East. All right, international expansion. Here you can see destinations, you can see new generation aircraft, how many are there? 78% current aircrafts are new generation. Then by 900 by 2035, they want 920 aircrafts. So they already have an order book of 920 aircrafts. So in the next 10 years, from 434 aircrafts to 920 aircrafts. It's a great expansion and one of the lowest cost structures globally with high aircraft utilization. So very efficient airline, even by globally speaking, global standards. And here it's mentioned, while Indigo is set to become the fifth largest while India is set to become the fifth largest outbound tourism market by 2027, Indigo plans to expand its capabilities in the international market, where it targets its capacity to be 40% by 2030 and to be around 20, from 28% in fiscal 2025. So in fiscal year 2025, 28% of its total capabilities were international, flights were international. They want to expand to 40% by 2030. Okay, so expanding in international. And what else? What else? And yeah, finally, one more thing I want to show was this. Yes, uh, revenue from operations, again in millions of rupees. So in sale of services, passenger services, you can see the majority of revenue comes from here, 74,000 crores in fiscal year 2025. Cargo services, so paying for like transporting cargo, okay, it makes money from there also, 2,000 crores. 2,000 crores is revenue this year. Now, sale of products, in-flight sales, 1,000 crores. Okay, 1,000 crores. These are known as traded products because, again, it does not make like the meals on the flights. It just buys them and sells them at a marked up price. Now, here it's seen other operating income. We got others referring to note 39 with 2,877 crores. Maybe you can research that. Then other income, a lot of other income, 1,000 crores of other income in the form of interest income from bank deposits. Okay, maybe we can search this 39 note for, okay, hold up. 39 note, 39B. Where is 39? Was it 38B? 39B. Okay, so I couldn't find it. Wait, was it 35B? Hold up. Wait. Oh, come on, man. It's not done. Refer to note 39. Refer to note 39. I need to find note 39. Note 39 is okay. Okay, it's a big paragraph. Okay, it's this big paragraph. No, I'm not reading all that. Fine. So majority revenue comes from around passenger sales, selling tickets, and then money also comes from interest income, and more importantly, money also comes from sale of, okay, cargo, transporting cargo plus food and all that money comes from there also. And finally, the last segment that we have is artificial intelligence. Now, this may sound confusing. So yes, yeah, I asked Google AI mode to give a summary of this company. Why does it have such good cash flows? Because cash flows are very important. So here's it has given the answer. Asset light strategy through sale and lease back. Okay, let's read. So Indigo places massive bulk orders for new aircrafts, securing significant price discounts from manufacturers. Okay, so Indigo initially first buys the aircrafts, actually buys the aircrafts. Then the airline immediately sells these brand new valuable aircrafts to leasing companies. So it's then sells them to leasing companies and generates a substantial one time cash profit that funds the immediate business needs. So it buys the aircraft on bulk, securing discounts because it's buying on bulk, and sells them to leasing companies and secures. Of course, it sells them so it can give a lot of cash. It gets a lot of cash for selling them. And then Indigo leases the same aircraft back for a fixed period, typically 5 to 6 years. This allows it to operate a modern fleet without massive upfront capital expenditure of outright ownership. So it buys the aircraft, then it sells them to another company, gets a lot of cash for that, of course, and then leases that same aircraft from the same company. So it can now lease it. It received a lot of cash front, and it doesn't have to deal with like capital expenditure of maintaining this massive aircraft, and it avoids an aging fleet costs. At the end of the short lease period, aircraft is returned to the lessor. So it's returned to the company it sold it to, the company who owns the aircraft, eliminating the costs and complications of managing and depreciating an aging fleet. Okay, so it doesn't need to face the problem of having an aging fleet because it can now just lease. It just buys new aircrafts and then sells them to other companies and leases them. So it can buy new aircrafts, sell them to like leasing companies, and then buy them from those same leasing companies. It has a short cash conversion cycle, very important. Indigo receives cash from ticket sales and ancillary services well in advance of a time, sometimes months ahead of time. Then, at the same time, the airline defers payments to suppliers for expenses like fuels and all, resulting in large and growing accounts payable on the balance sheet. We will explain this and boosts cash flows. This negative working capital cycle means Indigo's accounts payables exceeds its accounts receivable. We will look into this right now. Okay, finally, so it receives cash flows from advance and the sale and leaseback model we discussed. Now, what can be confusing is this. What do we mean by accounts payable boosting the cash flows? And how does it actually boost the cash flows? So let's go back to screener.com. Okay, here we are back in Screener. Uh, Under the cash flow section, let me expand cash flows. Okay, you see working capital changes. Working capital is the money the company needs to fund the daily operations, pay the employees, pay the suppliers, you know, all of that, and buy inventory, all of that. And here you can see payables. Payables are this massive positive. We discussed, right? If account payables exceeded account receivables, this massively boosts cash flows. So here you can see payables are massively positive thing for the company. Okay, payables. Like here, okay, directly below me, payables. Now pay attention to numbers, right to them. So for fiscal year 2025, you see payables 8,977 crores. These are in crores, 8,977 crores. Okay, payables, again, payables, massive positive. The money it needs to pay to its suppliers for supplies are known as the payables, the accounts payables. And again, they keep rising because the company is able to defer payments for like fuel and all that for the for the future, to the future. And you can see, yeah, that's it. Yeah, the payables have risen so massively. Such a good boon for the company, making this extremely positive working capital changes. Okay, working capital changes. Yes. So finally, that was it. That was Interglobe Aviation, double-digit solid growth in both operating profits and even revenues. Great cash flow growth, great free cash flow. It seems like we analyze a bit of the balance sheet. In its balance sheet, the main debt will be lease liabilities because the like the um it leases the aircrafts. So the remaining future lease payments it has to make discounted to the present value. So the present value of all the future lease payments it has to make, that is considered as its lease liabilities. And of course, interest payments are going to be pretty big for the company because it has leased all of its aircrafts. That was it. That was Interglobe Aviations, the introduction to the business, perhaps one can say. Have a nice day.